A quick one. We've done about, I need to get this, about 39.6% index return year to date in Nigeria. I mean, since 1st of January 2017, the Nigerian stock market has done 39.6% in terms of return. Is this real?
It is real because equity market returns are driven by two factors. They're driven by expansion in valuation multiples. When foreign investors start seeing your markets as being attractive with a positive macro story, they're going to be pricing your equity, they're going to be pricing your stocks at a higher level of valuation. Second factor that drives equity market return is earnings per share, earnings. And on both metrics, we have seen improvements. Earnings per share, it has improved across sectors in Nigeria and across the Nigerian market due to the rebound in macroeconomic fundamentals in the past 3 or 4 quarters.
Not because we're pumping the shares. Were we pumping the shares?
Not essentially. It's been driven by solid earnings growth both across the banking sector, the consumer goods sector, and even the industrial goods sector.
So what drives earnings?
What drives earnings is the macro story.
Okay,
right?
What is macro story?
The macroeconomic
I'm sorry, I got a lot of questions for you this morning.
This
is hot money.
The macroeconomic fundamentals.
Yeah, which means, if we break it down, meaning what? Consumer demand?
Consumer demand, number one, and for banking stocks, increase in yield in the fixed income markets as well, because that's where they put their assets in. So improvements in the yield, or rather the tight monetary policy by the central bank, which has driven up yields in the fixed income markets, it has increased the interest income of banks, so that they are now declaring record earnings numbers. And for the consumer and industrial goods sector, the growth in their earnings is not being driven by higher demand, but rather increase in the pricing of their products.
Yes, so you increase prices, but I've got to buy.
Exactly.
Which means the money is coming from somewhere. It's not free.
Yeah, essentially.
Yes.
Essentially.
So somehow there is something at the bottom of this economy where consumer appetite remains strong, even though prices go high. A loaf of bread moves up from 300 naira, from 250 to about 300, and folks are still producing more bread, and bread is still being consumed.
Correct. We are seeing improvements in consumer and business confidence, which is also triggering, these improvements in...
Very soft, but it's still there.
Yeah, correct. Definitely.
But again, let's go back to Broad Street. And look at the Eurobond and the debt market and add that to this conversation. When a sovereign go to the market, investors still buy junk bonds. So whatever you rated, folks still interested in Venezuela anyway, even though it's already becoming a basket case. But when you look at Nigeria, where is this? What's driving the appetite for the Eurobond from these folks we can call the hot money investors, which just did a Eurobond, the longest, 2047?
It's a push and pull factor. Push factor in the sense that in the advanced economies, because of the low interest rate environment there's a lot of demand for high yield emerging and frontier markets Eurobond. So even for companies with shaky fundamentals, they can easily tap the Eurobond markets as long as they can price in the risk, in the valuation of the bond at issuance. So that demand for high yielding, Eurobonds, it has led to a push factor that has made, most Eurobond issuances this year very successful. And there's a pull factor as well, because most foreign investors understand that Nigeria's business cycle is driven by oil earnings, essentially. And since the start of the year, we are seeing a rebound in both oil production as well as oil prices. So that means the macro story for the economy, at least in the short term, it has improved quite substantially. So that push and pull factor, it has been driving, the interest we are seeing in our Eurobond. So if you look at the Eurobond, the Nigerian Eurobonds year-to-date return, both across the corporate markets and the sovereign markets, they've all appreciated year-to-date in terms of prices, being driven by this high demand that we are seeing, as well as the positive growth story that we are recording in the economy.
Is it likely that as the administration begin to tinker with the yield on Naira local currency, LCY instruments for treasuries and bonds, do you think the appetite of foreign investors will remain, these hot money investors will remain very strong, even though we see yields being tweaked a little bit lower and lower?
Definitely, because if you look at 2014, yields were not at this level, but we are recording higher level of capital inflows than even now. I think so for these investors, what they want to see is further consolidation, of the rebound in macroeconomic fundamentals for them to remain invested in Nigerian assets. Definitely, yields have to come down because at the current level they are quite unsustainable and detrimental to the growth objective of the central bank as well as the federal government. So yields have to come down, and if you look at the fixed income markets in the past couple of months, you will see that at the primary markets, we're already seeing a significant decline in the issuance yield. For the 364-day HOMO, which is to be done at over 18.6%, that has moderated to about 17.8% or thereabouts. Also, if you look at the FGN monthly bond auction, we have seen a decline in the yield. The last auction that was done, both for the 10-year and the 20, both of the 5-year and the 10-year reopenings, they were issued at 14.8%, 20 basis points lesser, than they were issued at the October bond auction, and over 100 basis points lower than they were issued at the January bond auction. So that shows that we are now seeing improved appetite, for the LCY instruments.
I got a very quick question for you, and this is going to be the last one. Of what use, quick use? Hot money is quick, come easy, go easy.
Correct.
Okay, so what can we use them for as soon as we get them? Do they really have any benefit or impact on the economy, broadly speaking?
They are useful in stabilizing your FX markets when they are coming in, and they are useful in supporting external reserves, of the economy. But you do not want to waste a recovery. So as long as we are witnessing this, higher capital inflows, both the federal government and the central bank have to deepen reforms so as to make it very competitive to do business in Nigeria, so that these inflows can be used to support, business growth in the economy and diversify our export base, particularly.
Thank you very much. It's just the advice there that we should hold this hot money down and pour cold water on it, if possible, and so that it stays.
Correct.
Omotola Abimbola from Afrinvest, one of the investment analysts, unpacking that for us.